Mark Every joins us on Money Matters today. We're going to talk a little bit about investing and more specifically getting ready for our retirement, which we all need to do a better job at, I think. Mark, thanks for being here with us.
Thank you.
Now, right now the markets seem to be doing pretty well. Is this a good time to change our investment strategy? And if so, what kind of a investment strategy should we change, or how should we change it to be more advantageous for us?
That's a great question. We get the markets the past 12 to 18 months have been very good. So clients get, they see that gain in their portfolio and they question themselves on whether or not they should, good time to get out of the market. And what we tend to coach them on is, when we set up your investment account, it was set up for a specific goal or a specific objective, whether it be a purchase or retirement. And unless something major has changed, like your time horizon, your investment objectives, or your particular goal, we usually recommend you stay the course and don't knee-jerk react and try to buy and sell on time in the market, because nobody ever really wins. And what we found is that if you miss the 10 to 15 best days of the market, it has a significant impact on your overall performance of your portfolio.
What are the best investments when we have a strong market? Are there any bad investments?
Well, I guess when the markets are strong, again, each individual investment is going to depend on the client's risk tolerance and time horizon. When markets are strong, that typically means that stocks are doing well. So you'd want to be buying, solid companies with a good balance sheet, good rates of return, dividends potentially, things like that. And if you're not purchasing stock, maybe a good solid growth mutual fund is the best vehicle because of the diversification and professional money management and things like that. Sometimes those are the best performing when the market is doing well. As far as bad investments, there are bad investments out there, and individuals really need to do their homework, really need to rely on their financial professional to coach them and educate them on the different types of investments to make sure they're getting put in something that's appropriate for them.
Mark, you mentioned mutual funds. Are those really the best investment opportunity for us?
Yeah, I believe they are, especially for a more inexperienced investor. What a mutual fund gives you that an individual stock doesn't is diversification, which means instead of holding one company, I may own in the one mutual fund 200 different companies. So the diversification there. Also the professional money management. So you've got people that all they do is manage this fund or the mutual fund for you. So it takes the burden off of you following an individual stock going up and down. So for most people, I would say yes, a mutual fund is one of the better investments.
Now, you talked a little bit about diversity. How important is that, whether we're looking at mutual funds or if we're going out on our own?
Diversification is very important. I usually tell clients, if you think of a picture window, and if I hold one stock and a rock goes through that window, the whole window shatters. If that window is one pane out of 200 in the mutual fund, it doesn't have such an impact on my portfolio. So diversification is big. And you can diversify in many ways within one mutual fund, both domestic companies and global companies, small cap companies, mid cap companies, large cap, which are just different sizes of company capitalization, and then across asset classes too. So many ways to diversify a portfolio.
What about investing in bonds? Is this a good time to be getting into the bond market?
This particular time probably isn't the best bond market we've seen. Last year, most of the bonds were all down, because what tends to happen is when stocks are rallying or stocks are performing well, bonds suffer for that because people are fleeing to the stocks and the bonds are depreciating. But it's a tough environment for bonds right now to get a good rate of return, like it is for individuals trying to buy CDs right now. It's just that rates are so low, you have to go such a long term to get that return. It's sometimes not worth it. So people really need to weigh those risk versus return and time horizon options when they're looking at bonds right now.
Well, thank you so much, Mark, for visiting with us again about our retirement. It is such an important thing to have in line as we grow older.
Right. Well, thanks for having me.